Hey, Movie Trades! I want to do a video analysis update. Really not actually an update at all. I'm going to show some results that I really just threw together, back testing some very popular, in some ways controversial, but in a lot of ways just ETFs, whether they're actively managed or they have a strategy, they pay very high dividends, whether it's from, BDCs or whether it's from, a closed-end fund or an ETF or a fund manager or an active fund. You get the gist. We're going to go over some results of a pretty, kind of controversial topic. Should a person like me who invests in the stock market consider strategies like dollar cost averaging, right? Dollar cost averaging is something that people talk about a lot. And it's something that's quite frankly pretty dangerous to just say, oh yeah, I'm just going to buy the dip. I'm just going to buy the dip. And it's certainly dangerous to do that to the short side. Oh, I'm just going to average into puts more. Okay, so, but there are some really good active, managed ETFs in stocks that have actually rewarded investors for not timing them since their inception, which is pretty interesting. And they've also paid huge dividends while doing this. So these are a lot of things that, people don't think are possible. Maybe they're not possible, right? Past performance never indicates future results. And I'm not a certified financial advisor, but I do have some interesting results. I mean, this is what really kind of prompted me to make this video, right? Everyone's afraid of being called a bag holder. And I just think oil is such a good example, right? So this is not, a full coverage of this ETF by any means, but I just want to introduce this ETF as OILK. Let's just read what this index says. The ProShares K1 Free Crude Oil Strategy ETF tracks the Bloomberg Commodity Balanced WTI Crude Oil Index, aims to track the performance of 3 separate contract schedules for WTI crude oil futures. 1/3 of the index rolls a monthly roll schedule, follows a monthly roll schedule. The second third of the index follows a June annual roll schedule, while the remaining third follows a December annual roll schedule. Notice these are all quad witching dates, by the way. Oh, they're called quad witch? Anyway, I'm not going to get into that. Focus. The index weights are equally reset semi-annually in the months of March and September. I mean, really, astrology. Anyway, on the close of the first business day, this is literally witchcraft, to maintain the long position of the baskets. Contracts are rolled from the expiring futures contract to a new contract further down the futures curve with a longer expiry date. I mean, this is why paying attention to these dates is so important. And people are like, oh, no, that's crazy. What are you, a witch? It's literally saying right here that there's a massive transactions just habitually happening around these dates. All commodities will roll on the second and third business day of each calendar month. Okay, so but what's kind of the whole point of all that? This is the oil ETF, pays income. Got it, right? I'll look more into the prospectus and consider investing in it myself. But what I thought was interesting is the results. So we're going to look at just lump sum investing, the results of $10,000 and reinvesting the dividends versus instead of, and this is going to be considered timing the market, right? This is going to be considered timing the market, just making a lump sum investment and then reinvesting all the dividends, right? So doing that at the inception is actually pretty bad for OILK because a lot of people talk about dividend traps and dead money. In this case, this volatile commodities market actually did have a pretty big correction. And the lump sum investor is just now breaking even, after 6 or 7 years, right? Not technically a bag holder, but that's dead money. That's not good. But look at this. The person who decided to enter the campaign by dollar cost averaging a equal amount. And the key to this is an equal amount over time, every month, right? It's all about, in my opinion, dollar cost averaging over time. That's what, personally, I think a lot of people, when they talk about this, they have this idea that there's a dip, and then if that, 2 weeks later, that same stock is down 20%, that's where the average is. In my opinion, I'm not even going to think about that sector, for 2 quarters, 3 quarters at least, if I've already, made a position. But anyway, That veered off a little bit. Just the idea. Now that there are all these monthly dividends, of blindly, kind of dollar cost averaging, could that even be a concept? I mean, is it crazy? For OILK, I just think it's so interesting that the returns go from a dead money bag holder of 0.75% annual return to the person who chose to dollar cost average goes up to 6.838%. So in this case, dollar cost averaging massively, outperformed lump sum investing. That's kind of the logic. And for those of you who argue that over a long period of time, more money is being reinvested, that the compounding also works to the downside. It's all about the percentages. Big. I mean, and my rebuttal to that would be go start throwing in bad funds. Go start throwing in bad, stock. The compounding is to the downside, and to the upside. So 6.38% versus 0.75%, clearly rewarding dollar cost averaging in the volatile market, in the volatile oil market. So for these, I'm going to have the dollar cost averaging picture first. The second is going to be the lump sum investing. I talk about this one a lot. These magicians at Simplify so far, 13% annual return, just blindly dollar cost averaging into this ETF once a month. Pretty good. And this is during a time that most people think has been horrible for the stock market. A 13%, annualized return for the dollar cost averager into SVOL. For the person who just lump sum invest, a 10.69% annual return, a good bit lower. Okay, the JP Morgan NASDAQ Equity Premium Income ETF JEPQ. So this one's a little surprising. People think, I got to time the NASDAQ, right? Well, when equity linked notes contract in covered call contract premium is involved and a really good active fund manager is involved, it's kind of bizarre to see that it actually didn't reward, timing the NASDAQ. If you thought you could time the NASDAQ and just lump sum and invest into it, May 5th, 2022, which really wasn't even that far from the bottom, only an 8.7% annual return for JEPQ, the person who just said, YOLO, I'm going to blindly dollar cost average into this once a month, 18.97% return. Pretty wild. Okay, let's look at Clip and this is crazy because China, KWeb, the underlying, to the naysayers, throw in KWeb, it's a bloodbath. But with Clip, different story because the options premium, and I'm going to read into Clip's prospectus because I have a bizarre conspiracy theory. I'm going to read into this more. But JEPQ uses equity linked notes. I'm going to take a closer look at Clip's prospectus. I'm not saying I think they use equity linked notes. I don't think they do at all. But they have an interesting basket about what the other 20% of the ETF is. And I'm really going to get my magnifying glass out and see what the heck that is. Because I think that could help explain how the person who lump sum invests in the Clip right before KWeb takes a tumble still makes a 4.66% annual return. The person who chose the dollar cost average in the Clip makes a 7.9% annual return. I'm pretty sure that's higher than SPY's return for the year. Certainly it is for just dollar cost averaging into it. Anyway, that's Clip. Oxford Lane Capital, they call this one a dividend trap. I think it's got a crazy yield right now, 18 or 19%. Really, the person who lump sum invested, they made a 5.78% return. I kind of just wanted to include that because not too bad. That was during a good time for markets and stuff. But if you look at the chart of Oxford Lane Capital, most people would not think that's been a profitable investment, especially in the income sector. The results are a lot different, but the investor who dollar cost averages in the Oxford Lane OXLC, they make a 6.46% return. Perhaps, being a signal of some nice fund management. Speaking of nice fund managers, the Blackstone Secured Lending Fund, I gotta hand it to Blackstone. They're pretty good. BXSL, very interesting. When I looked at this stock, their website is still bragging about how I think what they credit. Yeah, I'm gonna look a lot more into this fund, and there's actually some great people on YouTube even and FinTwit and all that who have gone deep into kind of the dirty of this fund. Anyway, the results pretty good. But when I was looking at their website, they're still bragging about how the private equity, the private loans, right? I should probably have looked into it more, but they're still bragging about how like the private loans rates are so much higher, going back to 2021, like June 2021, and they're showing a picture, and that's still when like the treasury bill rates were like 1.5%, and I was like, oh man, would I do anything? I mean, just think about that now. I mean, now the treasury rate's what, 5.4% just in a year and a half. They haven't even updated their website. That's how quickly rates have exploded. But even with that big rate change, I mean, the person who lump summed into BXSL, 14.93% return, and they say fixed income is dead. Maybe it is, but look at this. The person who dollar cost averages into it, and there's this big volatile spike. This looks just like, the chart. And the whole idea is that it's going to smooth out the volatility. That's not what this line is representing. This line could also be representing just the extra increment. That's not why this line is smooth. The big thing right down here is this number, this annualized return, 19.08% for the dollar cost averager for BSXL. But the whole point is it takes advantage of that volatility and those lower prices by choosing to have a averaging in campaign. Very interesting. Aries Capital Management, popular one. I just want to get to the results on this one. I think I did periodic investments second on accident. The lump sum investor, 12.49%, extremely good. I mean, and people will just say every single stock that has a high dividend is a dividend trap. Don't tell that to the people running ARCC. The people dollar cost averaging into ARCC, definitely don't tell them that. They're making an even higher return. Stellus Capital Management Investment Corp, last one, SCM, new to this fund. But what I wanted to show is for ARCC, and I think for BSXL, but definitely for ARCC, and Stellus Capital Management and some of these BDCs, notice that for the person who isn't, they're just reinvesting dividends. They lump sum invested, and they've only chosen to reinvest dividends. They're still making new highs. And that's not being shown without the total returns. Stellus Capital Management, same thing. The dollar cost averager is beating pretty nicely the person who lump summed, but the lump sum investor, they're making higher highs, even while that's not being shown in price.